Hi, Steven Van Metre here, and welcome to your Wednesday night premiere. We take about 15 minutes every Monday and Wednesday night to try to make sense of markets that absolutely do not make any sense. How do we know that? Well, I actually didn't make notes today because I changed my mind on what we're going to talk about. But here's what doesn't make sense today. Why did it take a missile strike from Iran and then what was presumed to be a de-escalation, although if you saw it happen in the last 15 minutes, the market with some missiles hitting Baghdad, I don't know the details on that. You would think that maybe investors would say, all right, there's some risk out there. No, it took a missile strike for an intraday all-time high in the markets. That doesn't make any sense to me. The other thing that doesn't make a whole lot of sense to me today is how Tesla, who as far as I know, and for those who are wondering, I don't really follow Tesla other than what I see flowing through on Twitter. It's to me, it's a rabbit hole that you could get very deep in no matter what side of the fence you were on. But they are now the most valuable car company in history. And to the best of my knowledge, they sell very, very few cars. That doesn't make any sense to me. But what was driving the market today was most likely the ADP payroll report, which also will add to the list of things that don't make a whole lot of sense. So the ADP beat expectations. I think market was looking for around 160,000 jobs in December. ADP posted a little over 200. A lot of it, of course, coming from the services sector. We saw a small rebound in manufacturing, which kind of doesn't jive completely with the ISM manufacturing reports and some of the other things we've seen, but this is what ADP reported. They also upwardly revised the prior month. But here's why that doesn't make sense to me. If all these people over the last, say, several months have hitting the payrolls and have jobs, why are gas and distillates building? Are these people walking to work? Are they at green jobs where they don't use energy? That doesn't make any sense. Why are initial jobless claims starting to rise? Again, if all these people are going to work, why are we seeing jobless claims rise? I mean, that doesn't make any sense to me. How about falling mortgage demand? We saw this week that demand bounced from last week. Of course, last week there was a short week due to New Year's, so we could assume that it was going to be a slow week. But the overall trend in mortgage demand is falling. If all these people have jobs, are they not wanting to move on up? I don't know. Doesn't make any sense to me. And what are they doing at work? We can look at commercial industrial lending as we do every Friday. We will this coming Friday. So commercial industrial lending has been flat for 6 months. These people just standing around at work. What are they doing? So sometimes when you see these reports, now I do know the non-farm payroll report is faked by the Bureau of Labor Statistics. I'm not saying it's completely fake. It just gets revised down every once in a while. And I think next month we get a downward revision of 500,000 jobs that they overinflated. So we know that's wrong, but I'm really surprised by ADP. Are all these people really working? Are they carpooling? Are they living in the same house as other people? I don't know. It doesn't make any sense to me. But anyways, I had some other stuff I wanted to talk about. I want to talk about imports. So the import data is showing that imports are falling. Well, it shouldn't be a real surprise because we've seen exports, say, out of South Korea and China, Japan falling. So it would logically make sense at some point those declining exports become declining imports here. Now, we've heard President Trump wants a stronger dollar. And I'm going to show you he's going about it the wrong way. So this is a chart of the year over year change in blue of imports. And you can see this is as of November, I believe. So it is a lagging report, but just so you see imports are headed negative. And you can see this is the trade weighted dollar not on a year over year basis. So when imports are rising and are fairly strong on a year over year basis, the dollar weakens. And when imports contract, the dollar strengthens. You see it? So here you see strong year-over-year imports, declining dollar. Weakening imports, rising dollar. So what does this tell us? The direction of dollar. I'm going to tell you why this is in a moment, but I'll give you a chance to think about where I'm going with this. So what does this tell us the direction of dollar's head? higher because we know imports are going lower because we know there's a lag between when something leaves, say, South Korea and it gets here. We know it's not, overnight shipping. So we know imports are going lower, dollars going higher. What does that tell you for gold? Lower. So why are the smart money short gold? Because dollar's probably headed higher. Not in direct correlation all the time, but strong enough. Why is the smart money short oil? Because oil and the dollar are sensitive to each other, and a rising dollar means weaker oil. Now the question is, why do we see this relationship? Because it's all about world dollar liquidity. How do foreign countries, corporations, central banks, investors get dollars? When something is imported in the United States, it's paid for in dollars. We are the world's reserve currency. We pay for things in dollars. We do not pay in Deutschmarks or renminbi or whatever, pesos. We pay in dollars. So we give them dollars, they take the dollars home, and then they have to convert them to local currency. So what you're seeing in the import data is just validating that there is a dollar shortage and it's only going to get worse. Now, I want to talk about bonds because I'm not done talking about bonds, and I may not be done talking about them for a while. But I want to go through them more in a technical aspect on how we can look at the charts, because things are really starting to develop here. And the markets are a tug of war. So I haven't used these in a while, but think of this as a tug of war. The markets every day are a tug of war between the bulls and the bears. Now, we're used to seeing tug of war on a horizontal basis, but in the market, it's like this. So the bulls want prices to go up and the bears want prices to go down. This is what you see in the markets every day. And there's a way to interpret this and look at it. So who are the bulls in the bond market? Well, they are the large commercial banks and the Fed. Say, well, wait a minute. The Fed's buying $60 billion a month of Treasury bills. They're a bond bull. Who are the bears? These are the hedge fund managers, speculators, people that think inflation is going up and interest rates are going up, even though lending demand is falling, mortgage demand is falling, and gas and distillates are rising. I mean, that's not demand. That's the opposite of demand. But they're very bearish. They think interest rates need to go really high, 5-6%, but they'll settle for something less. Those are your two players. The problem for the bears is they're running out of runway. They've been going at this since, I believe, we'll look at the charts for, I think, since August. So that puts almost going to the 5th month of them being short the bond market. And what do I mean by they're running out of runway? Well, on Monday, the Fed is going to start to back off how much liquidity it's injecting through its term loans. And we do know, and I'll come back to this hopefully, is that hedge fund managers have access to the Fed's lending facilities and use those loans, those dollar loans, to speculate on the markets, to drive stock prices higher and to drive bond prices lower. Okay? Because everybody thinks quantitative easing means higher interest rates, except this isn't really quantitative easing, but that's a story for another day. So that's the positioning, is the hedge fund managers are running out of runway. Starting Monday, the Fed dials back how much they're going to lend, and it doesn't mean we're going to see some unwinding on Monday. It just means their access to the Fed's pool of money is going to go from a term loan of, say, a week, 2 weeks, 3 weeks, 4 weeks, to overnight. I mean, they're going to be fighting with other people to get those loans. So what does this look like from a chart perspective? And then I'm going to show you the chart. We looked at this the other day, and I'm going to come back and I'm going to show you using the arrows what's going on. So I've changed the coloring. So we see the triangle here. You see the long end of the triangle and the other bottom end here in cyan. You see down here are the bulls, the buyers, the Feds and large commercial banks. Up here are the sellers. Now, why does this all matter? Well, it matters a lot because when we look at hedge fund manager positioning, we see that in 10-year treasuries, they're fairly short. Not record short, not second record short, but they're fairly short. In 30-year treasuries, we see they're darn near at their record short position. I mean, hedge fund managers have been betting against the bond market going down. So that's their position. So we know. And you say, well, how do you know that the commercials are on the other side of the equation? Well, simple. For every bet down, there's a bet up. So the only reason the guy that runs Hedgeopia doesn't put the opposite in it, it's just assumed. So if there's this many short contracts, there's got to be this many long contracts. So there's no point in mucking up the charts to do that. So we do know the hedge funds are who's short. And we also know they've been going at this, since August. So we're going into almost 5 months by next week of them shorting the bond market. So what does that look like? Here's what we have. We have bulls, large commercial banks and the Fed, and we have bears. So here's what happened. So the bulls drove prices up, and all of a sudden the bears said, that's good enough. And then they pushed prices down this way. And at some point, the bulls said, we're good right here. We'll buy everything you've got. And the bears tried, push, didn't work. And then they pushed prices back up. And at a lower point than before, the bears came back and said, we're going to sell this back down. And around the same point as before, the bulls said, we'll buy what you've got here. And the bears said, okay, fine. And then it went up again, but not as high. And the bears said, this time we've got you. And they hammered the bulls down. And at the same spot again, the bulls stopped. And so then prices went up a little bit. Now we're catching up to 3 days ago. And the bears went, okay, we're done now. We're going to really show you who's boss. Boom, 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 boom. And guess what? It stopped again today. Now, at the end of this triangle, something very, very important happened. Either the bears win or the bulls win. Depending on what side of the fence you're investing in, all that matters what you're hoping for. Now, the question is, if you were, think about, you're in elementary school, playground stuff, and you're the last person to be picked on a team. Do you want to be on the side of the commercials, the banks and the Fed, or do you want to be on the side of the speculators? You probably want to be over here. Why I haven't sold bonds? You're wondering why I'm holding on to them. Because there's something is going to happen real soon. We're running out of runway. So here's the position right now. Now the bears are hoping to push through this point down here and cause the bulls to flip and sell. Now, are the large commercial banks going to sell? No, because they need collateral. Is the Fed going to sell? No, because they said they weren't. Doesn't make a lot of sense, right? So you see some desperation here. Now the bulls are hoping that they push back and all of those short positions become buyers and price goes up. That's what's going on here. And what's interesting about this is when you start factoring the dollar liquidity shortage in this, when prices go up, and I think that is what is going to come out of this, because the credit data tells us that the bears are going to become bulls and drive prices up. There isn't a lot of dollars for these hedge funds to go out and buy bonds, because what happens when, it's one thing to short in the futures market, but when you're in the cash market, the daily market, what happens is you to short, you go to a dealer and you borrow, or someone who puts their bond up to, or note up to lend, and it gets borrowed and sold onto the market. So now you have two copies. Now you see, that sounds weird, and I'll write about this some other time, but for every one U.S. Treasury bond, there's actually more than two in the market. And it's an anomaly. So what happens is when you see all the selling, it's flooding the market with bonds. Now the problem is when you get a reverse, these hedge funds have to go buy a bond to effectively pay back the bond they borrowed. Now, they don't buy the exact bond. They just have to buy a bond. 10-year Treasury is a 10-year Treasury, so it doesn't really matter too much. The problem is when there's a dollar shortage and you need dollars to buy bonds and there aren't any of them, what do you have to do? Sell your stocks. And that's why what is going to happen here is very interesting. Because here's your bulls, here's your bears. And again, remember, hedge funds selling down, bulls buying. Hedge funds at a lower point, sell down, 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 bulls buy. Sell down, down, down. It looked like the hedge funds broke through, the bears broke through. Nope, bulls pushed it back up, roughly the same point. Bear said, we got you this time. We know at the end of the year you got a liquidity shortage. We know the European banks might be having to sell. We got that article from Pozar at Credit Suisse. Aha! Nope. They stood pat. They got him. And then all of a sudden now I thought, okay, remember I thought this is going to be the breakout. Hey, I think on Friday I said this, we're crossing the line. We're going to start to squeeze this out. And what happened? It started to, and then all of a sudden short under a pretty strong volume. And you see massive selling, and then strong selling. And then what happened today? And you can say, well, the markets got lucky because of the missile strike. Maybe, but it held. It went up and came right back down in after hours, and it's holding this area. From a good news is, other than this gap here, and I don't know if this will even matter, all the open gaps from below are closed, leaving all the open gaps above all the way back up into here that need to get filled. So this is the big, gigantic tug of war. And the hedge funds cannot afford to lose this, because not only are they going to lose here, but they'll have to unwind their stock positions in what will become a quickly illiquid market. If the large commercial banks and the Fed win, then you're going to see a lot of unwinding here. Now, why does the Fed allow hedge funds to access their dollars? Well, they own treasuries. But here's another reason. What does the Fed need right now? T-bills. That's what they're buying. They have, remember on Monday we looked and said, hey, we're kind of running out. How do you get more? You get speculators to short the market. Go borrow some from someone who has it and dump them on the market so you can buy it. Do the hedge fund managers not realize who they're playing ball with? Playing ball with some big players. So the question is, what do you think? Do you think that the bulls are going to win or the bears are going to win? Because there's big stakes on both sides. If the bulls win, huge, massive move higher in the bond market. The bears win, which is going to be tough because they haven't done it yet. You would have to assume the Fed and large commercial banks are selling, but they're hoping to drive bond prices way down. As far as my bet goes, I think you all know. And if you don't, there you go. Bulls baby all the way. I'm Steve Van Metre. Appreciate you taking the time to watch, and we'll see you Friday. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation by or selling security, financial borrowing instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in this video that do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.